We come back to the Zamara Consulting Actuaries Survey. This is a survey that tracks the investment performance of retirement funds in Kenya. We've been publishing this for the last 12 and a half years every quarter. So it's a quarterly publication. When we released our first edition in March 2016, our survey covered just under 100 retirement funds in Kenya with a total asset base of just over 50 billion. Our 50th edition, which we released today, covers 417 retirement funds with a total asset base of 732 billion. So this represents about 75% of the total retirement fund assets in the country. So it's a very representative survey, and it very accurately tracks the investment performance of pension funds in Kenya and has become an accepted benchmark that is used by trustees and members of retirement funds as well as investment managers. And the ZCAS is the only survey in this market which goes back more than 10 years, right? It's 12 and a half years. So we've got a lot of data. As you're also aware, early in July this year, we launched the Zamara Kenya Equity Index. Okay? So this is a new index that we launched, which tracks the performance of listed equities in Kenya. It addresses many of the challenges that investors encountered with some of the existing indices that are used, and it creates an investable and a very readily accessible benchmark that can be used by pension funds, other institutional investors, both local and global. And this is published on our website, Neha, and it's published on the NSE website as well. It's good to note that the asset base of pension funds in Kenya is growing. In December 2017, the total asset base crossed the trillion shillings mark. Okay? And as we speak now, it's about 1.2 trillion shillings. And when we look at growth over the last 18 years, from the time the new legislative environment was brought in the year 2000, the asset base has increased 15-fold. Okay, so it's a 15-fold increase over 18 years. From about 80 billion, we've grown to 1.2 trillion shillings. When we look at other asset classes like private equity, so for example, the legislation was amended 2 years ago to permit funds to invest up to 10% of their assets in private equity. The current exposure is less than 1%. I think it's still 0.0 something percent, right? And if you look at it, the wider economy is outside. And private equity is a good way of gaining exposure to the wider Kenyan economy. And as Zamara, we are looking into this area, and we're in the process of launching a private equity platform that pension funds can use to invest in. Okay, so this is a work in progress, and we'll be talking to you more about this. The government is talking about building 500,000 affordable homes over the next 5 years. And we need to ask, if we build these 500,000 affordable homes, who is going to buy them, right? Because the challenge is not just getting affordable homes that are at a lower cost, say the 1 to 5 million range. The other challenge is the ability of people to buy those homes, right? And clearly, when you look at, for example, access to financing for homes, it's very, very difficult, right? Because mortgage institutions would be looking at the ability to pay before they are able to lend long-term to give a mortgage loan, right? Now, we believe this is where the pensions industry can come in and play an important role. So firstly, pension schemes are aggregators of capital, so we can deploy that capital into housing, right? The second point is that currently the legislation enables a member of a fund to be able to assign up to 60% of their benefit to get a housing loan, right? But when the financier is looking at the interest rate, they would still look at the ability to pay, not that there is additional security that is available, right? And that is why, even though we've had this legislation, the take-up has been very poor, right? But what if we allowed tenant purchase schemes? Right? What if we allowed, for example, to say that one can assign a portion of the benefit within the retirement fund, maybe even up to 20%, right? And say, we use this money to get a cash-backed mortgage, right? So you take 20% of your money, right? It is your money, it is still your pension money. It remains, it's still part of your pension fund, but it is put in a bank. So, and gets you a return of maybe 5%, but you get a loan at a cheaper rate from the bank. Right? Now, what does that do? It reduces your cost of borrowing, it improves your ability to pay, right? You've still got your pension secure. The only thing that you've done is slightly compromise the return that you would earn on it.